Wholesale prices in January coming in hotter than expected, making the road to rate cuts even more complicated. This week, Atlanta Fed President Raphael Bostic saying, quote, inflation might come down more slowly than the pace implied by where the markets signal monetary policy should be. Well, for what this means for investors, Liz Young, SoFi Head of Investment Strategy, is here. Thank you for joining us, Liz. Obviously, it's been a week when it comes to economic data here. Markets really just all over the place when it comes to this. What should we be focusing on? Because it seems like the Fed focuses more on PCE. Investors seem to be looking at everything else or not giving it as much weight.
Right. Well, we don't get the PCE data until later this month. I do think that because of the CPI print this week and because of the PPI print this week, now the data is stacking up against investors in a way that's making people more nervous. So I think there will be a lot more watchful eyes on PCE later this month. But so far what we've seen, and it's just really 1 month, and a lot of people have been saying we are expecting a little bit of a heat up in the January data. Even the Fed themselves, there have been a number of speakers that have said this is still consistent with the path that we were expecting. What we've seen, though, is that investors, I think, are getting nervous about the idea that we could possibly overheat again, and that risk is still alive. So the volatility, particularly the volatility that we're seeing in yields, is telling that story, that we're not quite out of the woods yet. Not necessarily that inflation is heating back up and on a new trend. It's just 1 month, but that risk that things could get hotter and not be going down in the linear fashion that we had expected is still around.
So I'm curious then, Liz, if we have that red hot CPI print and then we've got the hot PPI print, I'm looking at the market so far today. The S&P says, we're focusing on the good news. We're focusing on chips and Apple. I'm curious, at what point does the data start to make it difficult for us to be betting on this Fed pivot? When will the market start to believe in this Fed victory lap that's been happening throughout the week?
I interpret it differently. I don't think the Fed is taking a victory lap. I think that they've been pretty consistent with their messaging that we're not confident yet that we've solved the problem, which is why they consistently pushed back on that March rate cut. It moved to May, then it moved to June. And I think that strategy so far has worked for them because expectations of an earlier cutting cycle have completely dissolved. The yield volatility is showing us that investors are reacting to some of this data, but it's going to take, if we get bad data again for February, if things have heated up quite a bit, then I think investors really start to take heed that, okay, maybe we shouldn't even cut rates starting in May or June. And that's where we start to get nervous. So you have to think back about what caused that rally, what drove the rally towards the end of the year last year. It was the expectation that the Fed was going to pivot, that inflation had been solved, that rates were going to come down sooner than maybe we had originally expected. Now we have to unprice some of that expectation. And that's what's happening a little bit here. Equities have wobbled here and there, but only for about a day at a time. What I think would happen is if the data continued to stack up over the next couple months, that things were still too hot, then we would have to listen to the Fed, and they would continue to tell us, I think, that rates are going to stay higher for longer because we need to get confident that this problem is solved. And again, one of the things that Jerome Powell has said at almost every press conference, even in his prepared remarks, is that high inflation does not work for anyone. So that is a number one priority. They're going to continue to fight that battle.
So really quickly here, Liz, you talked about the volatility in the bond market. Does the bond market know something that the equity market maybe isn't clued in on yet or doesn't want to be clued in on?
I don't think that the bond market knows anything the equity market doesn't. It's all out there, right? The data is all available. I just think they're queuing off of different things. So the bond market is queuing off of the rate path. The bond market is queuing off of the fact that the yield curve is still inverted and that we still have some concerns about what rates will look like and how quickly rates will return to what the bond market would consider normal. Whereas the equity market right now, I think, is queuing off quite a bit of momentum, quite a bit of late cycle behavior, which does typically drive funds into large cap companies. There's still this idea of the theme of AI and this enthusiasm over it, and the fact that those companies have worked and continue to work. So investors have not been told or proven that they should be taking money out of them. So I think the equity market is just queuing off of something a little bit different from a momentum perspective. And one of the positives about this is that we are hanging on earnings. We are listening to earnings more. And I think that's starting to be a more rational place for the market to be. You want markets to react to fundamentals. The difference is if markets are reacting to fundamentals in an overly enthusiastic way, or if they start to punish an entire industry group because of one company's report. And I think that's the risk that we are facing in this concentrated market.
And so, Liz, when you do have a lot of this frothiness with every bit of economic data that comes out for markets, is this the time for some of the perhaps more beaten up sectors for people to start picking up there, get a bit more defensive here?
Yeah, I mean, sure. If you look at valuations, if we're looking at this purely from a valuations perspective, which is not what I think the market is doing today, but if we're looking at it from a valuations perspective, it would make sense to look at some of those sectors, not even necessarily beaten up, but the ones that have not kept up and the ones that we are hoping to participate in a broadening out. One of those last year was industrials, but industrials has now had a pretty nice run. And a lot of people would point to that as confirmation that the market is doing better and the economy is doing better than we thought. Some of the places that I would look are things like dividend paying stocks, which do tend to skew more defensive. So you usually see things like consumer staples and utilities as the top sectors. But there are some dividend ETFs out there that have industrials as the second sector in them. And as rates come down at some point in 2024, maybe we don't know when yet, but as rates come down at some point in 2024, dividend stocks may start to look much more attractive to investors who can no longer get 5% in a money market or 5% in a 2-year treasury. So that would be one of the spots that I would look where you can check both boxes with defensives and dividend payers.
That might be one reason we saw Meta adding about $200 billion to its market cap in one day after that dividend announcement. Liz, thank you so much for joining us. Liz Yun, always a pleasure to get your insights. That was Liz Yun, SoFi's head of investment strategy, joining us.